Hey, did you know if you plan a gift, the IRS will forgive a tax? Are you dialed in with your planned giving strategy? Welcome to the show, everyone. Show's called Your Money, Your Wealth. Joe Anderson here, certified financial planner, president of Pure Financial Advisor. We got a special co-host this week. It's Allison Alley.
Hey, Joe. How are you?
How are you, Allison?
Great. Excited for the show.
Hey, when you're looking at planned giving, the U.S. gives a ton of money. $499 billion in 2022. 60% of those dollars are given by us individuals. Do you have all the strategies dialed in? We're going to get through 6 of the top strategies for planned giving. That's today's Financial Focus. 64%, as I talked about, are individuals. We got corporations that give 6%, foundations 21%. So the majority of people that are giving money are us, individuals. But most of us are doing it wrong. Let's get dialed in. Let's bring in Allison.
Thanks, Joe. This is going to be a great show. We're going to go over ways to increase your charitable tax deductions. First and foremost, you want to start with figuring out your own goals. Then we're going to dive into the different strategies you can use to implement those goals, as well as figuring out the best way to put together a charitable plan.
Yeah, I think it's true that everything kind of boils down to the goals, right? Before you start putting in strategies and putting into your plans, it really boils down here. So let's dive in. So when you're thinking about your money, I think, Allison, you probably got to look at yourself first, right?
Yep. Absolutely. You want to figure out your own retirement first and foremost, right? Do you have your own retirement income needs in check? Do you know how much you need to accumulate to fund your retirement? If so, once you do that, then you can get into what do you want to do with your assets once you pass away? Do you want those assets to go to your own beneficiaries, kids, family members, etc.? Or do you want those assets to go to charity or nonprofits or both? And then once you figure that out, it's figuring out the different charities, identifying where you want those assets to go.
Yeah, and I think also when you look at people giving, people give on a weekly basis, monthly basis. You just want to make sure that that's part of your overall retirement income strategy. If that's part of your, day-to-day or monthly inflow of your income, you have to start planning for that. And then, of course, if there's money left over, then it's really getting to more sophisticated strategies on how to really maximize those gifts to whatever nonprofit, foundation, or charity. Now, a couple of different ways that you can give. I think most people, Allison, are familiar with here. They're just cutting a check.
Absolutely. Either cash to a different charity or writing a check is probably the most common, but it might leave some things out of the picture.
You could give your old car. Have you done that?
I have, actually. I did donate an old car once.
Some appreciated stocks. I think this is the most overlooked. We're going to get into some more sophisticated strategies that come into play a little bit more depending on your net worth and how much money that you're actually trying to give, such as you could give money directly from your IRA. Now, this came about a few years ago. Still, a lot of people are not familiar with this. Donor advised fund, and then also split interest gifts. So I think these are the most common that a lot of people are doing, but this is where they're leaving money on the table.
They absolutely are. If you're just giving cash or writing a check, you might be missing out on an opportunity. In this example, we've got a married tax filer, and they have total taxes of about $10,000, and they typically give to charity another $10,000. So their total itemized deductions are $20,000. However, currently, the standard deduction is $27,700. So in this situation, that $10,000 gift to charity isn't actually giving them any additional tax benefit over and above what they'd get with just the standard deduction.
Yeah, the new tax reform really kind of hurt a lot of people when they're giving to charity, because what they did is they really increased that standard deduction. So you can itemize your deductions, or you can take the standard deduction. And they try to simplify the overall tax code or how we're doing our tax returns. So they're giving everyone a lot larger standard deduction. So most people don't necessarily itemize anymore. But in this example here, this person was giving $10,000 away to a gift to either a nonprofit or a charity or foundation, the university or whatever it is, to get that tax deduction. But what hurts them is that their total itemized is 20, so they're still taking the standard. So that $10,000 gift didn't necessarily affect their taxes in any way, shape, or form. So here's an interesting strategy that you might want to do. Bunching. Let's say I'm going to give $10,000 to that organization. So instead of giving $10,000 a year, maybe I bunch that gift into 1 year. So 2023, I want to make sure that I get that tax deduction, so I bunch $30,000, and then here my total itemized is now $40,000. So I'm going to receive a lot larger tax benefit by bunching. The problem is that charity's not going to get any cash for the next couple of years.
Right, but in those next couple of years, you're still going to have that standard deduction, which you would have gotten anyways, and so this gives you a significantly larger tax deduction over that handful of years than if you had just given those dollars in each of those individual years.
Let's talk about another strategy. So I want to give $10,000. I'm going to just cut a check from my checking account and give it to that organization. Another more tax-effective way to do this, Allison, is potentially give appreciated stock.
Yeah, that's right. If you're already going to give $10,000 and you could just give cash or appreciated stock, giving the appreciated stock is still going to get you that same $10,000 tax deduction. However, you're going to save the capital gains tax that you would have to pay if you sold the stock first to then have the $10,000 to give to the charity. So you're still giving away the same amount of total money, you're still getting the same tax deduction, but your total tax savings is much higher because you don't have to pay the capital gains tax on the sale.
Yeah, absolutely. So let's say you bought a stock for $1,000, it's worth $10,000, you have $9,000 of gain. You could either give $10,000 in cash, or you could directly give that stock to the charity. The charity is going to sell the stock, they pay no tax. You could take the $10,000 that you were going to give the charity and go ahead and buy that stock back at a higher basis. So you're still keeping your portfolio looking the same, but much more tax efficient. If you want more help with this, you know where to go. Go to yourmoneyyourwealth.com. Get the Tax Smart Charitable Giving Guide. The Tax Smart Charitable Giving Guide. Yourmoneyyourwealth.com. Click on that special offer. We still got a ton to go. Don't go anywhere. Show's called Your Money, Your Wealth. Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson here, certified financial planner with Allison Alley today. She's a certified financial planner as well. We're breaking things down today in regards to charitable giving. Speaking of, go to yourmoneyyourwealth.com. Click on that special offer. It's a Tax Smart Charitable Giving Guide. Yourmoneyyourwealth.com. Let's see how you did on that true-false question.
Cash donations to charity can be claimed up to 60% of adjusted gross income, or AGI, while donated appreciated assets can be claimed up to 30% of AGI. That's true. Basically, we've got a couple of limitations. If you give cash directly to charity, you're limited to 60% of your AGI for that cash deduction. If you give appreciated assets, you're limited to 30% of your adjusted gross income. So this comes into play also. You really want to take a look at your income, where you're going to fall, so you can decide the best source from which to donate.
Yeah, if you're planning larger gifts, if you have $100,000, let's say adjusted gross income, and if I have an appreciated asset that I want to give away, or give to a certain organization, right, I'm only going to receive 30% of that. You get a little bit bigger bang for your buck if I gave cash, but again, this is limitations based on adjusted gross income. So if you have smaller adjusted gross income, of course will probably run into these limitations a little bit earlier. These are like people that are retired, that are creating income, that are really managing the taxes here. So it's just coming up with the right strategies to make sure that you understand limitations as you're giving these gifts. All right, let's get into strategy 3, qualified charitable distribution.
Here's a strategy that helps you avoid the IRS altogether, and who doesn't like that? You can actually gift directly to charity from your IRA. What that does is that keeps the income from even showing up on your tax return. So it's like getting a tax deduction, but without even having to deal with your itemized deductions, because the money never even shows up in your tax return to begin with.
A couple of things of why you want to do this is that if I'm taking a distribution from the IRA, right? Let's say I take a $30,000 distribution, I want to give $30,000 to charity. Well, that $30,000 is going to show up as on my tax return. It's going to add up to my adjusted gross income. It might add up to my modified adjusted gross income. But I have a charitable deduction on the other side that will offset it. But because it's on my tax return, I could potentially pay higher Medicare premiums. I could get stuck in some phase outs and things like that. So you could just bypass that altogether and go directly to the charity.
That's exactly right. So it's a win-win. It helps you avoid some other higher tax issues as well. There are a couple of rules you have to follow. You do have to be at least 70 and a half to take advantage of this strategy, and it is limited. You can do up to $100,000 per person. So if you're a married filing jointly couple, you could gift up to $200,000 directly from your respective IRAs.
I could give part of my or all of my required minimum distribution directly to a charity. So at 70 and a half, I hit my RMD age. Now, instead of taking the RMD, I don't necessarily need it. I don't have to spend it. I'm going to bypass the IRS and I'm going to go directly into the charity. But the Secure Act and the Secure Act 2.0 has pushed those RMD ages a little bit older, but still the QCD is still based on 70 and a half. So it's 70 and a half per IRA. So if you're married, you could give your RMD up to that $100,000 from your respective IRA directly to charity. Let's go to strategy 4.
Donor advised funds. If you want to give a larger amount or you want to speed up where you're giving your money, you can add money to a donor advised fund. You could take several years worth of your future contributions and gift it all at one time into this fund. You get a tax deduction today, this year, for the total amount that you put into that donor advised fund. And then from that fund, you can gift to the charities, nonprofits, foundations, etc. of your choosing over whatever timeline you want. So you're getting the upfront donation and deduction now, but the charities are getting the money over the time that you decide. In addition, because you're giving that initial donation now, it can help get you above that that standard deduction limit with your itemized deductions. It also allows you to potentially gift more to those charities over time, because when you put that money into the donor advised funds, those dollars get invested into a portfolio that makes sense based on your goals and objectives for those dollars. And as they're growing over time, it actually gives you more that you can give to charities as you want to.
Going back to our first strategy of bunching. Right, so instead of saying, hey, I'm going to give this organization $10,000 a year, that was my planned gift, that's what I've been giving this organization for years, but you know what, I didn't receive any tax deduction from it, so I'm going to bunch it, and I'm going to give that organization $30,000 this year, and I'll get that tax deduction, but I have to let them know, hey, I'm going to give 3 gifts or 3 years of gifts in one. But now, as we fast forward to the donor advised fund, this allows us basically to control the money and still give that charity that $10,000 per year. I put $30,000 in, I received that $30,000 tax deduction this year, and as Allison just said, is that I can still distribute that money out as I wish so that charities can still feel like they're getting that gift year in and year out. So donor advised fund, really awesome strategy, especially if you have a high income year. Right? So if you're looking for tax deductions in a high income year, now these have to be established by year end. So it's like, all right, well here, I have stock options, I sold my business. So these are very, very good strategies to help create that larger tax deduction to help reduce your taxes, but still doesn't disrupt basically your planned giving strategy each year. Here's another one, gift annuity. This is really good for retirees.
Yeah, this is one of 2 split interest gifts that we're going to talk about. First one here is the charitable gift annuity. This is where you could give a donation to an annuity, typically a foundation, a school, things like that. And you're going to get a partial deduction for the amount of your gift. In exchange for that, the annuity or the charity is going to pay you a lifetime income stream based on the amount of the gift and your age. So the younger you are, the lower that number, that annual income is going to be. The older you are, the higher it's going to be. And then upon your death, the charity is going to keep the remainder of that gift, but it gets you a partial deduction now as well as an income stream, and then the charity is going to get to use those dollars at the end of your life going forward.
Yeah, split interest. So you're basically taking advantage of that charitable gift today, and then the charity is going to ultimately take full control over those dollars at your passing. So if I'm looking to retire here in the next couple of years and I want to make sure that I give to a certain organization, I would look into that, because you could plan a gift and you split interest that overall gift. You get a great tax deduction up front today. They're also going to pay you a fixed interest rate based on, as Allison said, your life expectancy, right? So you get a fixed guaranteed income stream, and then at the passing, right, then it goes to charity. So you don't necessarily have to give that large gift here today to get that big tax deduction. It goes at the end of your life, but you can still reap the rewards as you're living. I know we're getting a little bit more complex, so to take advantage of some of this stuff, go to our website, yourmoneyyourwealth.com. Click on that special offer this week. It's our Tax Smart Charitable Giving Guide. Go to yourmoneyyourwealth.com. Click on the special offer. It's a Tax Smart Charitable Giving Guide. Your Money, Your Wealth. We got to take another break. We'll be right back. Hey, welcome back to the show. Show's called Your Money, Your Wealth. Joe Anderson and Allison Alley today, trying to make you a little bit more tax smart when it comes to your charitable giving. Speaking of, go to yourmoneyyourwealth.com. Click on that special offer. It's a Tax Smart Charitable Giving Guide. Yourmoneyyourwealth.com. Let's see how you did on that true-false question.
You must receive a written acknowledgment from your charity to substantiate all contributions over $250. That's true. Any donation over $250, your charity is required to provide you written acknowledgement of the gift. That's important. It also shows that they do good record keeping, and that's going to be part of the vetting that you're going to want to do before giving money to charity.
You don't necessarily want to give a bunch of money away to charity thinking you're going to get a tax deduction, and lo and behold, it's not really an organization at all.
Got to make sure they're on the up and up.
Let's go to strategy number 6. This is a CRT, or a charitable remainder trust. A lot of different names here for it, or a tax-exempt trust I've heard. So basically the concept is this, is that you're the donor, you're the individual, you have a highly appreciated asset. It could be a part of a business, it could be real estate, it could be stock, it could be any non-qualified asset that you don't necessarily want to sell because you're going to get hammered in tax. Well, what you could do is you could set up a CRT, or a charitable remainder trust. Again, this is another split interest gift. You put the asset in the trust. The charity, right, is a tax exempt organization. They sell that asset, they pay zero tax. What do you receive? You're going to receive payments from that asset over your lifetime. And when you pass, then the money goes to charity. So it's similar, like we talked about with this charitable gift annuity. Here you're giving assets to an organization. They're giving you a fixed rate of return over your lifetime based on life expectancy and age, and then the remainder goes to charity. Here you're going to control it a little bit differently. You're going to set up your own trust, your own foundation, if you will, sell it, get that income stream, and then it will go to the charity.
Correct. And this is pretty complex, as you mentioned. There's also some costs associated with setting up your own trust. So it is recommended that something like this be used if you're going to be making a donation of at least $100,000 to $250,000 to really make it worthwhile.
Wow, compliance.
Just saying.
Very good.
It's expensive. You got to make it worth it.
Let's look at some planning elements here. Okay, consider gifting amounts. How much money are you gifting is going to determine your overall strategy, right? So if you're giving large amounts of gifts, you probably want to get a little bit more complex. If I'm giving a few $100s, right, you could probably just go ahead and cut that check. Vet your charities.
Yes, you should vet your charities. There are a couple of organizations that you can take a look at. You can also go to the IRS website to see your charity's tax returns. The organizations that do rate charities are CharityNavigator and the Guidestar by Candid. You can go to both of those websites and check out the charities, check out their leadership, their programs, the overall organization. In addition, on your charity websites, you should see these two labels if they've been vetted by either of these two organizations.
And then what strategies are going to work best for you? You know, this is going to be dependent on how sophisticated you want to get and basically how large of a gift that you're really planning on giving. Do you want to give it now? Do you want to give it later? Do you want to give it at death? right? And then just write it down and make sure that you implement the overall strategy. All of this is really nothing unless you actually put the plan into action. All right, let's switch gears a little bit. Let's turn this show over to the viewers.
All right, first question comes from Mallory in Hawaii. What are the tax benefits if I name a charity as a beneficiary in my will? Well, if you just want things to go to charity upon your death, great. If there's a way for you to also get a tax benefit during your lifetime before you pass away, then some of these prior strategies that we've been discussing might be the way to go.
Yeah, if you just name a charity as the beneficiary of your will, it just goes to charity. There's no tax benefits for the donor in that given year. So, which is fine, which is great. If at the end of life, this is where you want your money to go, but you might want to look at some other strategies to say, hey, as I said, right, if the IRS has put this in the tax code, if you plan a gift, right, if I'm charitably inclined, right, the IRS will forgive a tax. Because the money's going to go somewhere. Do you want it to go to the IRS or do you want it to go to an organization that you really care about? So stepping back and doing some overall planning is probably the best bet for that particular situation. So, what did we learn? What did we take away today? Smart, charitable giving, analyze your needs and goals. Just making sure that you have it in your overall financial plan. Now you can get into some tax saving strategies and then develop a planned giving strategy. Of course, if you want more help, go to our website, yourmoneyyourwealth.com, click on the special offer. It's a tax smart charitable giving guide. That's our gift to you today. Allison, well, thank you for joining me today.
Yeah, it was my pleasure.
We'll see you next time, folks. Have a wonderful weekend.